Mike and Tom are registered with Steward Partners Global Advisors. Common Sense Finance with Mike Wiginton and Tom Farrell of HL Wiginton Capital Management, an independent investment and financial planning firm in downtown Jasper. Mike is a chartered financial analyst charter holder, and Tom is a certified financial planner professional. They are here to discuss and give their thoughts on current financial and economic matters. Now, with Common Sense Finance, here are Mike and Tom.
Hello everybody and welcome back to another edition of Common Sense Finance. This is Tom Farrell, I'm Mike Wiginton, and today we're going to discuss an article. Normally these types of articles I kind of brush off. You know, it's a hard thing, as I've said a million times, to constantly find something to write about if you're a so-called journalist. I'm not sure exactly what that is anymore, or if there is such a thing or such things. But coming up with something that is legitimate to write about every day of the week that's a hurdle. That's an onerous obligation, and I think that oftentimes, especially in our field, people write about things that I think, what's the big deal? I mean, you're making something out of nothing.
Right.
But today's discussion is over IRA mistakes to avoid. Okay, and so we come across some of these. That's a big deal every year. You're getting close to tax time, which we just passed, and people are calling at the last minute trying to do this or that, and sometimes it doesn't work out like they think. So why don't you?
Well, the article you're referring to was 20 mistakes to avoid. So I narrowed it down to 7.
Yeah.
So for the sake of time, so I'll get right into it. And these are things, we don't necessarily see in our practice. Sometimes we do, but I think some of these are good things just to consider. Maybe good practices. Anyway, the first thing is we do have some of this. Wait till the last minute. So April 15th, you want to make your IRA contribution for the previous year. So obviously, that causes some stress on people, trying to get things done the last minute. But really, one of the main things that I think makes this a mistake is you're giving up, if you have the assets to do it, you're giving up a whole year of tax deferred growth in your IRA if you wait till the last second to make that contribution. So you could have put it in, over a year beforehand, and if you had some 10-15% run up in the market and you're participating in that in your IRA, then you're going to have to pay taxes. If there's some taxable gains on that, you're going to have to pay taxes on it, where you could have put it in the IRA sooner and avoided that. So that's one thing we do see on occasion that happens. The other thing is, people debate, and I know we've had this conversation before, is between, hey, I'm going to put it in a Roth versus put it in a traditional and take the tax deduction now. Well, you can do both. Now, you can't fully fund both, but you could split, if you're allowed to do a $7,000 contribution, you could split that in half and do half in the Roth, half in the traditional. So it gives you some kind of a tax break now, but also gives you a tax break in the future. So a lot of people don't realize that, but that's something that you can certainly, a strategy you can certainly deploy to fund both of those.
Why don't you just go ahead and put those?
No, I don't want to wear them the whole time. You lost my train of thought.
That's a lot better.
Another mistake people assume is that a backdoor Roth is always tax-free. So it's not always tax-free. A lot of times it is. So if you don't have any assets in a traditional IRA and you make too much money to fund a Roth, you can put money in the traditional IRA and turn right around in a short period of time and convert that to a Roth. Not a problem, not a taxable event. If it is, it's a matter of a few cents. But
an immaterial amount.
Anyway. Immaterial amount. But if you have a large traditional IRA, whether you're using that to convert funds to a Roth or not, if you do a Roth conversion, the pro rata rule, which basically says the part that you're taking out to convert to a Roth is going to be pro rata as far as your overall traditional IRA balance, and you will end up having to pay some taxes when you do that conversion.
All right, but so hold on right there. That's in a situation where in that IRA account you have both dollars that you took off your tax return, pre-tax dollars,
Correct.
and dollars that are not that you already paid tax on, post-tax, after-tax dollars, where you made contributions into that same IRA that you made too much money, whatever your circumstance was, you couldn't deduct that from your taxes.
Well, I'm more specifically talking about, that is a scenario. I'm more specifically talking about somebody that maybe they had a 401k and they rolled it into an IRA.
Right.
And they have a larger balance or some balance in there that they're not going to convert. When you do the conversion of, say you're just doing a $7,000 for 1 year conversion, you have to account for the money that the tax, pre-tax money that's already in your IRA when you're calculating how much taxes you would need to pay on that conversion.
Okay, all right.
That makes sense. The next item is not contributing to an IRA later in life. And we see this a lot in our practice, and I'm sure it goes on, where somebody may retire from a certain job that they've had for a long time, their career, whatever it was, and they're going to do a little side gig, part-time job to stay busy and active like you like people to do in retirement. And they make enough money to make a contribution to the IRA, but a lot of them just don't do it. I think it's a great way to put more money over into an IRA, even if they have, and what some of our clients do is they may have a joint account or a regular brokerage account. Hey, even if you don't have enough free cash flow from your part-time job, if you have substantial enough assets in a regular brokerage account, hey, you can move those over as long as you make enough money to qualify for whatever deduction you're trying to take. And it's a great way to put more money in a Roth if you want to save up for, and grow that money and be able to take it out tax-free, or to maybe save some money on your taxes and use a regular IRA deduction for that. So that's, a lot of people overlook that, but it's something you need to continue to do as long as you have some earned income. So the next thing is having the wrong assets, and we don't see this a lot, obviously, because we advise and control the assets that are in IRA, but we have seen this with folks that are maybe at other firms, is they have the wrong type of assets. That they may have muni bonds in an IRA, or they may have an annuity in an IRA that really is not serving any purpose, because an annuity, one of the qualities of an annuity is it's money inside that grows tax deferred. And some people will have annuities inside an IRA. It really doesn't make sense. So having the wrong type of assets, that's one mistake that we do see on occasion, but not here.
I would say we see that on a fairly regular occasion.
Yeah, we do. Another mistake we see, and we don't see this a lot here again, but we have seen it, is, hey, you're RMD age, you're having to take the money out of your IRA, you don't need it, you've got income from other sources to support your lifestyle, not reinvesting those in some other type, in a brokerage account. And we encourage that here, and we do a lot of that, where we'll just move the money directly from the IRA into the brokerage account and continue to have it invested and working. So, but not everybody does that. They think, well, I've taken it out now, so I need to spend it on something that maybe I, don't really need. And then the last thing is, and I know you and I have talked about this several times, is not using, if you are RMD age, not using charitable distribution from your IRA. It's not going to make a huge difference, but it will reduce your adjusted gross income, and you're going to get a little bit more benefit out of that than deducting the charitable contribution. So it's easy to set up. If maybe you're tithing to your church, or maybe you give regular to some other charity, you can have the money go directly from your IRA into that charity, and it doesn't count towards your income for that year. So that's one thing to consider. I know we have several clients that do that, but if you are making regular charitable distributions out of that, it'll help you a little bit on your taxes. So those are just a handful of things that we see that maybe some things to think about that you're not doing, or that maybe someone would benefit from.
Okay, well, that's good. If that's the last word on
That's
that,
it.
we'll leave it there. We'll see you next time.
Controversy. You get high. Does your daddy cry? Controversy. 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 Do I believe God? Or do I believe me? Some people wanna die so they can be free. So life is just a game. We're all just the same. Controversy. Controversy. Controversy.